Hi, this is Joshua Schlinsky, and thanks for joining me here today for a few minutes. Now, I want to talk about the 4 different types of annuities. Now, first and foremost, you've heard good things about annuities, and surely you've heard bad things about annuities. And as I tell everybody, there's no such thing as the perfect financial instrument. There's good and bad about everything. The key is education and knowing what might be right for you. So let's just take a look at the basic differences between the 4 different types of annuities. Now, the oldest type of annuity is an immediate annuity. So now, an immediate annuity is like your grandfather's annuity. This has been around for years and years and years. And the thing about an immediate annuity, just think pension. It's simply a stream of income. You give the insurance company $1 million, and they're going to give you a stream of income based upon your age for as long as you live. You live to be 120 years old, they're going to continue your stream of income. But if you die the next week, they keep all the money. That gives annuities a bad name. A lot of people say, well, if I die, I'm going to lose all my money. Yes, in this type, that is the case. All right? Now, frankly, I don't recommend this to very many people, unless maybe they're well into their 80s or something of that nature, because not only is it a pure life annuity, meaning that if you die young, you lose it, but you lose all liquidity, use, and control of your money. Okay, and I like to help my clients to have as much liquidity, use, and control of their money as they possibly can. So there's a place for an immediate annuity, but again, really for people over the age of 80, when their mortality is better known, or if they're in a specific situation where they have no other choice. So that's where an immediate annuity might have a place. The second type of annuity is a fixed annuity. Now again, a fixed annuity is pretty simple, pretty black and white. Think of it just like a CD. So what's a CD? You go to the bank, you give them $1 million, they say for 5 years they're going to give you an awful rate of return, right? I mean, we're in low interest rates. So, but let's suppose, 5-year CD at the bank today is maybe 1.5, maybe 1.8. Well, the insurance company would probably give you today about 3.25%. Nothing to jump up and down about, but it's just a simple financial instrument. You give your money to the life insurance company, and they're going to give, for a specific term, they're going to give you a specific rate of return. Nothing complicated about it. Now, before I go on to the next 2, I just want to make sure, are you familiar with the fact that an annuity is a financial vehicle that is only issued through a life insurance company? Some people say, oh yeah, we knew that, and some people have no idea. So it is only offered through a life insurance company. So my next question to you, since the name of my business is Safe, Secure Financial, and that's what I specialize in, protecting people's money, how safe do you believe that your money is in a life insurance company? Well, a lot of people aren't really sure about that, but let's take a look at the most recent financial debacle of our lifetime in 2008. Okay, Lehman Brothers was allowed to go bankrupt. Bear Stearns was sold for pennies on the dollar. Merrill Lynch, Bank of America, Goldman Sachs, Wachovia, Morgan Stanley, all these big financial institutions had to be bailed out by the United States government, meaning you and me, Mr. and Mrs. Taxpayer. But can I ask you, did you hear of even one life insurance company that needed to be bailed out? Yeah, there's always somebody that mentions, but what about AIG? That's a life insurance company. Indeed, AIG needed to be bailed out, but AIG is an insurance conglomerate with different companies. So AIG has a company that does insurance for homes and farms and automobiles and airplanes. They're actually the largest insurer of airplanes in the world. That's casualty insurance. Okay? And then they have their investment banking insurance. Now that's what got them in trouble, making all those, all that gambling that was going on Wall Street, they were insuring that. Now, they also have another subsidiary called American General. And American General is AIG's life insurance company. Now, I personally have life insurance with American General, and I have a lot of clients that have annuities with American General. Now, in 2008, if AIG was not bailed out, American General, their life insurance company, would have been sold off as their greatest asset. The only thing that would have changed on my life insurance policy would have been the name on my annual statement. Would have been perfectly safe, because life insurance companies are highly regulated. They're under the legal reserve system, meaning that they have to have dollar for dollar in reserve to meet their obligation. That's not what banks do. Banks take in $100 and loan out $1,000. That's fractional lending. Life insurance companies can't do that. On top of that, they have to have a surplus account. And on top of that, there's reinsurance companies, and each and every state has the state guarantor fund that guarantees a certain portion of your money for a life insurance company. And you know what? The states don't even fund that because states are broke. It's the life insurance companies themselves that have to give money to the state to protect their own industry. That being said, you can go back historically, you do not find life insurance companies that need that type of protection because they are highly regulated. So I've just told you how safe your money is in a life insurance company, but then there's something called a variable annuity. Now, frankly, a variable annuity is not as safe as the other type of annuities. And to tell you the truth, I'm not a big fan of variable annuity. Because what's the definition of the word variable? Something that goes up and down, something that changes. So here, the insurance company, they've created a product to compete with Wall Street. So they're putting your money not into the insurance company's general account, but into mutual funds. Now, if you want mutual funds or you want to be in the market, then stay in the market. Have a managed account. There's substantially less fees. So when you hear, certain commercials out there that say, oh, annuities are so expensive, well, there's no real expense in a CD, in the fixed annuity or an immediate annuity. In a variable annuity, though, indeed, there are high fees. There's administration fees. There's rider fees. There's trading fees. And other fees included as well. And they often add up to be 3.5%. That is a pretty high fee. Now, you can get a guaranteed income rider or a death benefit rider, but we can get those benefits for you with a lot more safety and a lot less fees. Now, there's a lot of variable annuities out there, and I can't begin to tell you how many times I've come across them where I've been able to evaluate them for people, show them exactly what they're paying, what their benefits are, and often how we can put them in a much better situation. Now, the fourth type of annuity is a fixed index annuity. Now, a fixed index annuity, you might have heard this before. Some people might call it a hybrid annuity because it takes some of the best features of the other annuities and puts them together. So here they use an indexing strategy where 100% of your deposit is guaranteed from day one. You cannot lose it. So let's suppose you put in $100,000 in day one and the market goes down the next year. Well, you don't lose a penny. You stay even. Now what happens is when the indexing goes up, you're going to go up from where you were. So if the index goes up the next year, let's call it the S&P 500, you're going to go up from where you were. If it goes up again the next year, you go up from where you were. Now let's suppose the market goes down again the next year, you stay level. And when the market goes back up, you go up from where you were. Sounds too good to be true. I understand that. Now, for the insurance company to give you this guarantee of downside protection, there is some type of mitigation on the upside, either a cap or a participation rate. But I can tell you, over the course of time, these products work. My mom, as of today, is 85 years old. She retired 19 years ago. She put almost all of her money in fixed index annuities at that time. My mom is very, very conservative with her money. Okay, and she wanted to have a good retirement. She'd worked very, very hard, and she wanted it protected. Well, my mom went through the crash of 2000, 2001, 2002, didn't lose a penny. Where everybody else was just trying to get back to even in 2008 from that crash that they lost money, my mom was ahead of the game, so to speak. Okay? When 2008 came along and the market tanked, my mom's money stayed level, and many of my other clients as well. And my mom has had a stress-free, at least a financially stress-free retirement for the last 19 years. Is this right for everybody? No, of course not. But if you'd like to get more information to see how a fixed index annuity might benefit you, simply call us at our office at 954-843-3450, and you can have a free consultation to see how any of these strategies may benefit you.